Welcome, my name is Jeff Driver, General Manager Business Development and Investor Relations for Australian Foundation Investment Company. We've just announced our full year result to the 30th of June 2021, and I have with me today Mark Freeman, the Chief Executive Officer of Australian Foundation Investment Company, and David Grace, a Senior Portfolio Manager within the investment team. So Mark, we've just announced our profit and there was a slight decline over the year, but what were your main impressions of the full year result that we've just announced?
Well, we were very pleased with the result, Jeff. The portfolio performed ahead of the benchmark, the index. It was obviously a very strong year, so that was very pleasing. I guess a couple of other factors, the returns we've generated, not just over 1 year, but over the longer term, they're at a much lower volatility than the market, which is also pleasing. So good performance at very low volatility. And we've also been able to sustain the dividend. But as you said, dividends we received were down on the year. There was obviously companies that cut their dividends last year. We had to take that into account. However, we do have reserves that we can call on in these tough times, and we've done that in the past. We did that during the GFC and historically in other periods when markets have been down. That money comes through some of the capital gains we realised throughout the investment cycle. So we draw on those, sustain our dividends. We know dividends are important to our investors, and that's what we've been doing. But it's interesting that most market participants are expecting a rebound in dividends looking forward, particularly in the banking sector.
So Mark, I guess the other key feature of the result, which we always pride ourselves on, was the very low management expense ratio.
Yeah, well, that's also been pleasing. It's coming at about 0.14%, and just reminding everyone that we don't have a performance fee. So an extremely low cost, and there is no external fund manager with this business. The shareholders own the company. They own effectively the funds management business. So that was also very pleasing.
So Mark mentioned, David, the fact that we outperformed over the 12-month period. What were the main reasons behind that outperformance against the index?
Yeah, it's been a really strong period in equity markets over the last 12 months, and that's been supported by lower bond yields and improving corporate earnings, really following a very difficult FY20. Looking at our portfolio performance, really the key driver has been the increased weighting that we've had to high quality companies. So being larger parts of the portfolio, and they're companies like ARB, Reece, James Hardie, Mainfreight and ALS. And looking forward, we sense that all of those businesses have a good opportunity in front of them. And just reinforcing another point Mark made was just in terms of the volatility, the portfolio has remained low despite the performance. So we consider that to be a good risk-return profile for investors.
Thanks, David. So the other part, I guess, of the portfolio management, we have been sort of focusing a little bit more on the quality, what we assess to be quality companies, and reinforcing those weightings within the portfolio. Have you got any sort of comments around what activity was undertaken during the 12-month period?
When we look to make an acquisition of a new company, we're very focused on a company's position within their industry. So we're looking for those that are market leaders or have the ability to be able to establish that market leadership position. In the last 12 months, the largest acquisition was PEXA, which was an IPO late in the period. So PEXA is a digital conveyancing business and really stands to benefit as conveyancing moves from the old paper-based to online. The company has 80% market share and a really opportunity for good growth going forward. Other acquisitions we made, we added to our holdings in two companies that have been in the portfolio for some period of time, both Woolworths and AFICs. And really short-term weakness in their share price gave us the opportunity to significantly add to our holdings there. In both, we recognise are outstanding businesses and really well positioned for growth going forward. We added 4 other companies to the portfolio in the last 12 months. The first of those was Domino's Pizza, and smaller companies in Fineos, Temple and Webster and Nanosonics. On the sales side, we exited our holdings in South32 and Illumina. So they're both resource companies. We've seen strong growth in the commodity prices that they're exposed to, and we felt that the share price got to a level really reflecting the long-term growth opportunity in those businesses. So we saw better opportunities elsewhere for that capital. And the other one was Brickworks, which we've exited. Again, a really strong rally in the housing market over the last 12 months. And with the share price having benefited from that, we felt it got to a level where the long-term opportunity was being priced into the share price.
Thanks, David. So I'll ask you both this question. We've got another 12 months ahead of us in the market. So what's your sort of expectation, particularly Mark, around dividends, for example?
Yeah, dividends, we expect them to bounce back, and as I said, most market participants we speak to, they're forecasting that rebound. As I mentioned, banks, and there are a number of other companies that sort of cut or reduce dividends. When we look back 12 months, we expect those to come back to some extent. The operating environment and where markets go obviously has been a very strong performance from markets, not just here in Australia, globally. But I was always taught, you know, don't pick markets. Markets are very hard to pick. Just make sure you've got a portfolio of great companies, and that's what we'll seek to do. So I don't want to make any big prediction, but look, just to highlight, we did back in March, right at the lowest point in the market, we did an update for shareholders. It showed, if you look at factors like price to sales, price to book, markets here and overseas look quite cheap, very low compared to their long-term average. That's reversed, and now we're right at the top end. So again, sometimes markets can keep going up, we can't control that, but it looks certainly full of value to us. But we're just going to make sure we've got good companies that have good opportunities to grow.
Okay, thanks, Mark. I suppose just one other question, David, on the outlook, as inflation sort of seems to be percolating away a little bit. Sort of comments about how that potentially impacts the companies we have within our portfolio?
Yeah, we think about inflation in two ways. First of all, just the rising input costs and what that means for companies to be able to maintain the margins they've been able to produce. We feel the companies in the portfolio, as I said, largely got a market leadership position, and they're really well positioned to be able to largely pass that on. And then secondly, if inflation leads to a rise in bond yields or a move from central banks away from the easing policy, that will put pressure on equity valuation. So our expectation is we'll see some volatility over the next 12 months, and we'll look to add to companies that we really want to be larger parts of the portfolio that meet our quality criteria.
Okay. Mark and David, thanks for your time, and hopefully investors have appreciated this video. Thank you very much, and we'll see you next time.